I'm Dan Smith, President and CEO of the Community Foundation. I know many of you on the call, but not everybody. In a moment, I'll hand it over to Mike Miller of Crucial Consulting, our investment advisor, for their update on both our performance and some of the broader trends that are affecting markets and the economy right now. But I wanted to take a moment just to introduce you to our new VP of Finance, Nancy Brock, who is on the call today as well. Nancy, if you want to just give a wave, we'll put you on the spot.
Hey, everybody.
There you go. Nancy comes to us after a long career in both for-profit and non-profit financial management. We're really thrilled to have her on board. This is the start of her third week at the VCF. So just welcome aboard, and thank you for diving in, and looking forward to working with you over time. So anticipate seeing Nancy on these calls, and feel free to reach out with any questions. Welcome, Nancy. So Mike, if you want to dive in and take it away.
Thanks, Dan. I will do. I'm going to share my screen so everyone can see the slide deck. Hopefully you can all see this. Give me a second. For some reason I can't. Oh, there we go. I'm looking for a button. There's the one. Perfect. So, well, good morning, all. It is nice to see many of you on the call today. And we obviously live in interesting times, and there's a lot of things going on in the world, which I'm not qualified to cover all of them, but some of them we do think a lot about. And obviously the focus of our thinking from a professional standpoint, and working with the Vermont Community Foundation and with Dan and Nancy and the committee, is on what affects capital markets and what affects future returns. I will tell you, despite the many things that are going on in the world that are very disturbing today, the one thing that's not disturbing to us is the way in which capital markets are offering some truly breathtaking opportunities today and some breathtaking risks. And so we'll talk about both of those as we go through some of the reasons behind them and what we're thinking about and doing in the portfolio, which I hope you will find confidence inspires your confidence that the returns of the long term are going to be continue to be quite good. So so we'll start right at the top, which is the returns of the pools. Which, this is through March. I can tell you that through yesterday, these returns are all quite a bit more negative, as you know, in line with capital markets. Actually, the performance gaps to the benchmarks are shrinking a little bit, which is fine, but the opportunity is still very much alive and well, which we're excited about. So here you can see each of the three major pools, the long-term pool at the top, and its returns compared to both a custom benchmark, which I will talk about a little bit in a minute. But basically, what that custom benchmark is, it reflects an index-oriented strategy for implementing the foundation's strategic mix, which I will show you in a moment as well. And what you can see is out to 5 years that the portfolios actually lagged that benchmark. We'll talk about some of the patterns behind that and the reasons for that in a minute. Longer term, you see for 10 years a modest premium to the benchmark, and for 15 and 20 years, significant premiums to the benchmark. Actually, we're just hitting our 20-year anniversary interest in it. It didn't even occur to me until just now. The SR pool, the socially responsible pool, is right underneath it. You can see it's actually had stronger returns over time. This is in part for a lot of reasons. One, it's a great pool, just like the long-term pool is. And two, as a socially responsible pool, it is avoided many of the more cyclical, older industries that tend not to fit into socially responsible mandates or ESG mandates, depending on how you define that. It also has larger weights in areas like technology and disruptive industries that tend to be more suitable for socially responsible mandates. So some of that is cycles back and forth, and I'll show you a graph in a minute that takes you through that. And then last but not least, certainly not least, is the midterm pool, which is essentially an index pool that is meant to be for shorter philanthropic time horizons. So those first two pools at the top are meant for very long time horizons, endowment or endowment-like assets, essentially, where there's a distribution rate and the objective is to perpetuate the value of a fund over generations, essentially. And that's why we've listed the CPI plus 5 at the top too. That's going to be a very instrumental part of the presentation today, is talking about the CPI inflation that's a reference to, and how do you get to inflation plus 5%. This is a subject that consumes, I think, every reasonable fiduciary as it should. It's a complicated subject, particularly today. So I'm going to flip ahead, and please, along the way, I'm happy to take questions at the end, or along the way, if you, I'll try not to speak like I'm from New York City too much and slow down once in a while and take a pause, but please try to jump in if you'd like, or you can, of course, wait till the end if you prefer. So now, just to go back for a second, oops, sorry, I'm going to one. One of the problems with this graph, or this chart, I should say, is it makes a 3-year number look like it's just as important as a 10-year or 15-year number. And in fact, if you go back to what I said earlier, which is we're looking to compound capital at rates that exceed the CPI plus spending, or at least stay in the neighborhood of it. The short-term stuff is important because we have to do our job, but the long-term stuff is what really drives outcomes. And so what we did is we created a chart for you that takes these are the exact same numbers you saw on the prior page. And what it does is it turns them into compound returns, essentially, or cumulative returns, I should say. So the ones before, if you looked at that slide before, those are per year, and these are compounded over time. And here you can see, for example, the 1-year shortfall that I didn't spend a whole lot of time about, I'll come back to in a minute. You can see that the shortfall, there's been a shortfall for 3 years compared to the long-term benchmark, and 5 years. So those are the numbers we looked at just a minute ago. And just to get to the punchline, a lot of what's behind that is a value bias in the portfolio at a time where you want to own growth stocks. And we're feeling quite good about that as we speak, even though you don't see it in the numbers yet. And I'll give you some examples in a minute. But then over longer periods of time, those types of biases in the portfolio tend to cycle in and out of favor. And so it really does later on in longer periods become a question of whether or not you're doing a good job allocating capital or not. And I think that's why the long-term numbers matter so much. But more importantly than any of that is just the way in which compounding really does make a big difference. Let me just go back for a minute. So you remember here, so 7.4% per year compared to 6.2% for the benchmark. And then that's actually 309.6% compared to 226% for the benchmark. And I think that's a really important way to think about what looks like a decent sized difference. The bars are in different order, as you can see, but it's actually a very large difference over very long periods of time. And so we spend a ton of time worrying about 10, 15, and 20-year periods because they're just so much more important. And even little differences between you and an index become very big differences over time. And this is all about dollars now at the end of the day, and what happens to the dollars that you have entrusted to the Community Foundation. So I don't actually have any love, and I'm sure you don't either, of the 44.2 compared to the 49.7 for 5 years. That does not make us look particularly good at what we do, but we'll do that all day if it means that we get what we have on the other side of the page here. So we'll suffer the embarrassment, for lack of a better word, maybe some of the doubt we create when we underperform, because we're doing things that we think will absolutely lead to the future returns that you see here. And in fact, right now, it doesn't get much better than this today, frankly, in terms of the absurdity of what's going on. But with that said, these are important numbers. Now, we've also drawn these arrows because this is going to tie into what we're going to talk about later, which is risk and where the markets are today and where the world is today from at least a market perspective. I'm not going to do a full stretch on the world. I'm not qualified to do that. But what you can see here is that if you look at the last 10 years, so we've added the CPI plus 5 as an index here, which was on the other page too. And you can see the pools actually match that index. And the custom benchmark has just been slightly short of it, 100.4 versus 106.1. And I highlight that for a simple reason, which is that over the last decade, the reality is that all you kind of had to do was show up, and you could probably achieve your CPI plus 5 goal. It wasn't that hard. Bond market wasn't that terrible. The S&P 500 was wonderful. And so you had a really easy time getting there. We're glad we had a benchmark premium. We're glad that benchmark premium was the difference between falling a little short and getting, basically achieving the exact goal we were seeking to achieve. That's fine. But now look at the 15 and the since 2002 period. So since 2002, by the way, is our start of our time with the foundation. That's why we picked that date. Here you see a very different picture. So again, the bar of CPI plus 5, by the way, very challenging. We have had a hard time keeping it for 15 years. And for the 20-year period, we're still a little bit short, but close. But look at how much further below that orange bar the red bars are. That's my message for today, which is that's what our next decade probably looks like. It's going to be a lot harder to achieve CPI plus 5. We'll talk about the various reasons for it, but just to give you the quick version right now, the CPI is not going to be as low as it's been. That's the first problem. And you can sort of see that in a little 3.9% return so far this year. It's much worse than that, of course. The second reason, interest rates rising, mean the bond market won't be as benign a place. And the third reason is that unfortunately, the stock market, if you define that as the indexes, the cap weighted indexes, despite being down, whatever, it's down 17% or so year to date now, these indexes are still very expensive by historic standards. And to be clear, an expensive index doesn't tell you that you're going to have a terrible return next year. In fact, it can go up and up and up. What it does tell you, though, is that the odds of getting a good return over a decade are much lower than they normally are. We just got our good decade. The next decade probably is tougher. And again, you and I could have a long debate about whether it really will or will not be tougher, but history tells us it'll be tougher. I'll show you why in a minute. And the fact is that we're not in the business, nor I would hope you would not expect us to be in the business of betting on something happening that's never happened before. That rarely happens. Our goal in life is to do things that are likely to work, not things that are unlikely to work, no matter how popular they may be. So this is a really important perspective on what we're thinking about and how we're looking at the problems of the world. So I'm going to move on. I showed you earlier the ways in which the socially responsible pool has outperformed the long-term pool. So the problem with any kind of a chart, like I showed you earlier, is it's got a little statistical issue, which is not insignificant, called endpoint sensitivity, which means that if you have a really strong period at the end, you can make a long-term record look much better than it actually was. And so the graph you saw in the beginning sort of suggests that the socially responsible pool has been this consistent winner compared to the long-term pool, when the reality is that they've actually cycled back and forth, which is exactly, by the way, what Dan and the committee and the foundation as a whole want to see. They're both good pools, and they both should have their day in the sun. If one only does well, the other one doesn't, then we have one pool is clearly inferior, and that's not the case. So what you can see here is the blue line is the long-term pool, and the red line or orange line is the socially responsible pool. And we're comparing these to a 60-40 index. We could have brought a new index. We got rid of the custom indexes because we wanted to compare them to each other. And what you'll see here, these are rolling one-year periods of time from December 2006. We took that because that's the start of the socially responsible pool. Again, that's where that date came from. And you can see that the orange line actually spent quite a bit of time in the beginning lagging the SR pool, the long-term pool, excuse me. And I actually do vividly remember, I'm not sure if any of you were on calls we were doing back then, saying, hey, the long-term pool's got some great qualities. It's doing really, really well. Don't count the socially responsible pool out. The fact is that, if technology and healthcare stocks, the kinds of things that a little bit more of, tend to be dominant, you will see this pool outperform it, which is exactly, I didn't predict the timing. Obviously, we knew that we'd be in a different world, but you can see that the socially responsible pool has been on a very strong run for quite some time. And then you can also see one last thing is the way the long-term pool struggled in here. This is the right side of the page. Around December 2020, March 2020, excuse me. And that's COVID hitting. And COVID did a lot of things to this portfolio, none of them which were very good. One of which was it took the value bias we had and made it look even more foolish than it already had looked for a little while, because we were focused on having high quality businesses at good prices. That's not the way you were going to do well in that market. But then you see what happened since then is this massive rebound, which actually exceeded the social responsible. Now it's come crashing back down to earth here a little bit. I can tell you this crash, which we'll talk about a little bit later, it's not crash, it's a terrible word, excuse me. This return to even with the benchmark is a better way to say it. This is because we have a portfolio that is now holding companies that I actually still am shaking my head that they could possibly be trading these prices. These are largely consumer businesses and other types of growth businesses around the world. They're not the big index names, they're other names. I'll give you some examples later. But it's fascinating to me that the market's giving us these companies for free right now. This is almost exactly what it's doing. It's truly stunning. And we're having a very hard time, and forgive the expression, not feeling very greedy right now and really excited about what's going to happen next to this portfolio. But that's the cycles of returns. So as a reminder, just to set the table for how we think, you've heard a little bit of this already. You're not going to hear an economic forecast from me. We will talk about inflation. We'll talk about what's happening in the world, of course, but we don't believe in the philosophy of trying to guess where the world's going to go, where the economy is going to go, and then position the portfolio accordingly. The main reason is we just don't have any insights into what the world's going to be like that other people don't already have. So our view is like, nope, we're not going to do that. We're going to think long-term because it's consistent with the time horizon of this pool and the goals of those who are in this pool. 2, we're going to avoid making mistakes around things that we don't know anything about. And one of them would be what the economy is going to do next year. We have no idea. And 3, and this is the key thing, we're going to just keep buying $1 worth of assets for less than $1 if the market offers us those opportunities. We're going to diversify the portfolio of all these cheap dollars we own, and we're just going to wait and let all these things do the work for us. And so it's a very interesting strategy in some ways, because when it's not working in the short run, it's a little frustrating because people are like, oh my God, what are you doing? And the answer is we're just doing what we've always done, and we're waiting. And we're obviously very vigilant, and we make changes to the portfolio. We take advantage of opportunities because the markets offer them. But the fact is that it's long-term, point 1. Point two, don't know where the market's going to do next year. I had a client, not here obviously, say to me about a month or two ago, he called me up, he said to me, everyone tells me the market's going to be back up by the end of this year. What do you think? And I said, I wish I knew. I said, I'd be prepared for anything if I were you, because that's not the point. The point is if you have a long perspective, you don't care if markets drop, as long as it doesn't do any damage, of course, to the capital that is serving philanthropy in Vermont and elsewhere. And then last but not least, we diversify, because diversification is a very important part of not taking on too much risk. So this is a complicated page, apologies for it. But it's complicated for a reason, which is that the investment committee considers, with Dan as well, the strategic mix of these three pools, considers it once per year. And they do that because this is, first of all, we don't do it every meeting because there's no reason to change it on an annual basis. And two, we make small modifications. It's like watching grass grow. When we see opportunities in the markets that are so extreme, they push us to want to do something different on a long-term basis. So when you see changes, remember, they're reviewed annually. They're not changed annually, just to be clear. A lot of times we leave things just the way they were. What tends to cause us to change is a radical shift in market pricing or the environment as a whole. So first two columns are the long-term pool. Prior, as the name suggests, is the mix that I showed you 3 months ago. And long-term pool mix is where the committee and Dan moved the mix. So you can see very, very small additions to things like small cap equities, emerging markets a little bit, and something we call special opportunities, which is the more kind of esoteric concentrated strategies we use within long-term pools equity portfolio. So those special opportunities are equity strategies. So we had 58.5% of the assets in public equities. Now we have 60.5%. That change was made, and of course the markets are down since that change was made. Completely unimportant to us. In fact, the market's just giving us more and more bargains. We're happy to take them. If you look underneath that, you'll see 17.5% down from 19.5% in fixed income. And the big change there was to get rid of below investment grade credit or high yield bonds. And this is a way we're keeping risk neutral in our way of thinking in the portfolio. So if you're going to raise your equity exposure, the other thing we did is we took away the speculative credit exposure that was embedded in the bond portfolio. It wasn't much, as you can see, but we got rid of it entirely. The risk reward for equities is better than they are for below investment grade bonds today. So what you'll also see, though, and this is something that might surprise you, we're still holding 17.5% in bonds. There are those who will say you shouldn't own bonds. We disagree, and we disagree at small levels, because, first of all, no one's taken recessions or even depressions off the table. It's a scenario that might happen. And there's only one asset that really saves you in that time, which is a longer duration, high quality bond. People don't expect much for them, which is fine, but they can be very useful in a very, very bad market. So we shall see. But you'll also see at that level, we've diversified the bonds quite a bit. We have a decent size, actually pretty significant exposure to Treasury inflation protected securities. It's been extremely useful. We've had that for a long time, by the way. We didn't put that in because we thought inflation was coming back. We put it in because it structurally diversifies assets, and it gave us an inflation hedge, which we liked. That's worked out quite well. And then we also own non-dollar or global bonds because we're adding a little bit of currency risk in as well to try to get us a bond return with maybe a little bit more return and a little more diversification. That's what's happening there. The last thing at the bottom you can see is we reduced the hedge fund exposure in favor of more private assets. This is mainly because hedge funds lose the battle for returns and risk profile in this portfolio today. They're not a zero for us, but it's been a frustrating part of the portfolio, as you know, for a lot of people. It's starting to look like it's going to be coming back, we think. But with that said, private assets have been an enormous success. The foundation's had amazing returns there, and we're happy to have a little bit more there, but we're not going to go too far, just to be clear. And then second set of columns, I'm going to pause for questions, and then I promise I see something in the chat, so I might take a look at that. The second set of columns is the strategic change to the socially responsible pool, where here you see that pool also having more in equities than it had before, with a good chunk of that going outside the US, by the way, in terms of increasing. That's where the opportunities are better, frankly, when you look at risk reward. We did lower bonds there and essentially shifted to more of a short-term exposure. We have less diversifying tools given the socially responsible mandates. We don't own hedge funds, for example, which I'm sure many of you are happy to hear. And we have more in bonds because we want this pool to have a volatility profile that looks like the long-term pool. That's how we get to these numbers. We did increase the private assets there too, because there's a lot of really interesting things you can do from a socially responsible area in private assets. And then last but not least, we'd only have one column for the midterm pool, and that's because we didn't make any changes to it. So here, I'm just going to read a couple of the questions that have come up. Why is the socially responsible pool less volatile than the long-term pool? It's got more bonds, and that's made it less volatile than the long-term pool. I wouldn't count on that always being the case, but bonds are a much more reliable diversifier than hedge funds or private assets, for example, or anything else we do. So you're more often than not, you're going to see that. So that's one question. Okay, Dan answered my other question, so I think I'm good. So the allocation adjustment was done at the first meeting of 2022. I'm not sure if everyone can see that chat. Okay, I will continue on. Let me just take a quick pause and see if anyone has questions.
Question, can you hear me all right?
I can, go ahead.
Can you give me an example of your private assets, the kind of companies that have been bought and sold, whatever?
Yeah, so the private asset portfolio is pretty diversified, but it's got a focus on growth equity and venture capital. And so there are some buyouts in there too as well. So the type, it owns smaller tech names and consumer names. Amongst the successes though, the biggest success it does an investment in a fund called Consonance, which was made 8 years ago. They did a roll up of managed care facilities. It's a healthcare oriented fund and sold it at 10x their money essentially. So these are private companies, everything from early to late stage across most industries, but focused in the US with a tech and healthcare bias towards them. Did I answer your question?
Thank you very much.
You're welcome. All right, so I showed you earlier how the pool has not short-term, but long-term outperformed its benchmarks. I'm just gonna spend a very quick minute on how we pick managers and how the pool picks managers. So the first thing is that our firm, Crucial Partners itself, we formerly named Colonial Consulting, we rebranded about 18 months ago now. Our firm has 18 people on the investment team whose job it is to not just make sure the ones managers we have are good, but go find new managers to constantly create this we call healthy competition for capital in the portfolio. We actually normally like index funds a lot. We're a little more wary of them today for reasons I'll talk about in a minute, but indexes are very good too, and they're part of the balance and they keep the fees down, as everybody knows, which is extremely important. But if you were one of those 18 people at Crucial, and I'm chief investment officer, so they report to me and I get to have the pleasure of working with them and guiding them and learning from them, which is always amazing for me. And you'll see we have 4 basic rules that you have to follow. Rule 1, returns are always accompanied by risk. This is one of the things in investing I find very fascinating. People don't like risk, but the reality is you can't invest if you won't take on risk. You have to take on risk. It's just what it is. And it makes you uncomfortable. I will tell you as an advisor, it makes me extremely uncomfortable sometimes, and especially when things don't look so good. We have managers whose portfolios are down a lot this year, and that feels bad. And frankly, we're feeling good about the fact that they're not going to stay down, but there's always risk. And the question we ask ourselves isn't how do we get rid of risk? We ask ourselves, what exactly are the risks we're taking, and can we live with them? That's a very important point, because if you can't live with a risk, you probably shouldn't take it, mainly because risks always find a way of showing up, probably at the worst possible time, and you can't ever extinguish them. And so the risks we avoid are things that are irrecoverable. So we're very, very willing to look stupid in the short term as long as there's a long-term benefit from that. What we're not willing to do is lose your money in a permanent way, not own something that leverage and other factors can basically take away returns, and time does not fix that. Second point, the people who manage money at the Community Foundation and these pools, all the pools, except for the midterm pools, almost all index funds, we know these people. We know them well. We spend a lot of time with them, and that's a critical part of this. And frankly, one of the biggest challenges of COVID for us, other than all the normal things that everybody went through, was that we were not on the road visiting people, looking people in the eye. It's extremely important. In the last 9 months, we're back out on the road again. We're all vaccinated and boosted, and I haven't gotten COVID as far as I know, but we spend a lot of time on airplanes again, trying to, we think we need to do this to do our job, and it has its own set of challenges today. One place we don't take risk is operationally. So there's always an independent custodian, credible auditor, outside administrator. Crucial has 2.5. We have a person who's on contract who's right now not that busy, but will be soon, that do what we call ODD, which means operational due diligence. They vet these managers extremely carefully, verify the auditors, verify everything, read all the policies, interview the managers, have very long questionnaires they fill out internally that make sure that we're not taking that risk, because operational risk is completely unacceptable. It is a risk that you do not get paid to take. And then last but not least, this is a forward-looking process. So one of the things I think that I have to tell you, one of the things, there are times where having a mediocre investment committee, which is not the case here, is fine. If the world's benign, if the markets are benign, you don't need to be that good. Then there are times where things get complicated and messy. And that's where you need a great investment committee and a great person like Dan leading the charge too, on top of that, and in concert with us a little bit, which is because things get messy, they create opportunities, but those don't look like opportunities when you stare at a performance report. You see a manager down a lot. Most of us have this instinctive need to get rid of that person, get them out of my life. That's exactly the wrong thing to do when they're in fact owning things that are actually very attractively priced and even got more attractively priced. We don't pay managers to predict the future. We pay them to buy good stocks and own them for the long term. So being forward-looking means that sometimes you ignore the returns that you're looking at on that piece of paper. That feels odd to people, but it is so important, especially if you just accept the fact that things are cyclical. Smart people sometimes look smarter than they are. Dumb people sometimes look dumber than they are. And sometimes the worst part for us, and we've seen this in tech land until recently, dumb people can look smart, smart people can look dumb. You have to be really careful about the cycles and the way they really create sometimes participation awards. So I will not torture you with this. This is a list of all the things, and there are many more that the team focuses on. When we bring a new manager to the table, the committee gets a 10 to 12 page report that walks them through the thesis and doesn't cover each of these issues per se, but generally does, plus others. And so we're very focused on thoroughness because I mentioned that we know people really well. We have to show the committee and Dan that's the case. So let's change gears. We are living in an incredibly complicated time. You didn't need me to tell you that. We identified the three issues that I'm going to address a little bit right now, which is that inflation is, no one's using the word transient anymore to talk about inflation. I think we can put that term to bed for now. Rates are still quite low. As I mentioned earlier, indexes for the equity markets are still quite high. This third point, we might be able to remove it now. It's something we put in about a year or so ago when we were watching markets have this speculative bubble emerge around particularly new agey innovation, disruptive stocks. And there's, I've stopped using examples because I think I insult people when I pick on something they might like, but there are examples out there of funds and ETFs that are really the personification of this issue. Price always matters in investing at the end. And when you pay unlimited price because the story sounds good, you sometimes get hurt really badly. With a lot of those stocks down 70, 80, 90% right now, the price isn't quite as much of an issue anymore. Now it's just much more good old fashioned, are they good or bad businesses? So that's something that we think about too. I just got a question that came up before I keep moving on. So I'm going to read this one. If you guys send it, was back to the manager level, so I don't want to lose it. So what is your approach to investments where the ownership or management team has undergone significant change, merger, or acquisition? An excellent question. Thank you, Ron. Our answer is something I didn't say earlier, and I don't like the phrase, I won't use it, but we assume people are terrible until they prove otherwise. It's probably the nicest way to say it. So when something changes, sorry, I sound like a terrible person to hang out with. I know we're not that mean, I promise, but we feel like there's a lot of mediocrity in the investment business. And if you decide that you start thinking somebody's good, you'll get fooled more often than thinking they're actually good when they're not. So we tend to take the negative view, which is say, you know what, prove to me that you're not good, that you're good. Excuse me, I'm going to assume you're not good. And the reason I do that is because it creates a lower failure rate. Less mediocrity makes its way into the system. And the big negative of what we do is that essentially what we end up doing is sometimes we miss great people. Sometimes a great person just can't prove they're great and we miss them, but we'll take that scenario versus the one where we let a lot of not great people into the portfolio. So that's why we think about it that way. So tying into this question, when something changes, we go right back to that playbook again, which is, okay, starting all over, you're probably not any good unless you show us otherwise. And so generally speaking, if there's a significant change of ownership, management, et cetera, we're usually heading for the exits. Although not always, to be clear. We give people a fair shot in that context I described earlier. And then that's what we do. So we're generally somewhat hostile to those kinds of changes. We're also very focused on one more thing, which I don't think we've covered before. I'll mention it briefly now. Alignment of interest. If Mike Miller tomorrow, and it's not going to happen, so I can use it as an example. If Mike Miller sells Crucial to somebody tomorrow and puts a lot of money in his pocket personally, is he as motivated to work as hard as he does now with his team and care as much as he does? I mean, hopefully he's a good person and he's going to continue to try really hard. But if he's sitting there with a big bank account, maybe he won't. And so alignment of interest is really important. And when someone sells their business, we kind of feel like they're not as well aligned with us anymore, that they've already made their money and now we're just sort of there for the ride, whatever happens next. We don't really like that. We like them all being kind of aligned with us in a very serious way. Okay, so let's start with risk. Back to the markets now. Here's a picture that if you own the index, should bother you, which is that unfortunately, because we've got some really big companies in the world right now, we've mentioned them in prior calls, and I'll bring them back again today. The index has gotten more and more concentrated in its top names. So these are the 5 largest weights of the S&P 500. So the S&P 500, for those who aren't familiar with the way it works, is S&P or Standard & Poor's picks 500 names that they believe represent the US economy. They have a variety of criteria they use. There's a committee, and it's essentially a selected group of 500 companies. And then what happens is they've got those 500 companies, and the weightings in the index are based on what we call the market capitalization of the stocks, which means how many shares do you have outstanding times the current price? That's market capitalization. So the amount of money essentially in each company is about as it goes by its value. So what this chart does is says, well, let's just take the top 5 names. So bigger companies have a bigger weight. That's what the capitalization does. So as we go back to 1990, you can see that the index has had as little as, frankly, 10% or so in its top 5 names. And today, this is, I think, through April 30th. Today, you can see it's actually 22.4% as top 5 names, which still means that there's 78%, doing a little bit of rounding there, that's not in the top 5 names, to be clear. But this is disconcerting. This means that the index itself is riskier than it normally does. Again, assuming you think those top 5 names could have problems. About a year and a half ago, I think, or so, I'll probably bring it back at some point, we showed how every era has its darlings. It used to be, believe it or not, companies like Intel and ExxonMobil. I mean, there's a whole bunch of names that today people are like, what? And those were the big names. They were very popular at different times in history, Cisco. And now they're nothing burgers, essentially, as far as the markets and the index is concerned. And the problem is, as those names come down to earth, which they always do, the bigger names, if you have a lot more in them, and that's what the index has, you lose more money, you have a harder time generating good returns. So this concentration is part of the concern that I think everybody should have today. It's even worse if you look at the issue of growth versus value. So I'm not whining as much as I normally do, but we have a value bias. It's created some problems for us performance-wise, I showed you earlier. So that's where the whining sometimes starts, which we're not wrong. But the fact is that it's been a market where you really wanted to, until this year, really own the growthier companies. And growth companies today in particular are even more distorted than the value names are. So this is the exact same measurement. So now we're using different indices. That was the S&P 500 before. This is the 10 largest, not the 5 largest, but otherwise these are the value and growth indexes. So the Russell 3000, unlike the S&P 500, is actually just the 3,000 largest companies in the United States. They reset at Frank Russell Company once a year in June, I believe. And then what they do is Russell has their own way of dividing companies into growth or value. Believe it or not, they do something crazy, which is at least I think they used to, I haven't looked recently, they used to put some companies in both. Like, Microsoft could be 80% one index and 20 the other, not that it is. And so they have this kind of weird algorithm they use, but they create this indexes and they're separate indices. And what you see here, this is not a performance chart. The performance wouldn't look that much different, but it isn't the performance chart. This is how do the top 10 names look as a percentage of the indexes. So that dotted red line is the value index, and the blue line is the growth index. And you can see the top 10 names in the Russell 3000 growth. Again, the Russell 3000 growth probably has, I'm guessing because I don't know, but 13 or 1,400 companies in it. But again, they're capitalization weighted, so the big ones take up a lot more room than the small ones. And in the neighborhood of 70% of the index is in 10 names. 10, by the way, very popular names. And there's an old rule which I would urge everyone to keep in mind, which I love, which is this phrase that I heard years ago when I was a child in this business, a long time ago, was risk is greatest when agreement is greatest. And agreement is very high around the big names in these indices today, and that should be disconcerting to people. I just saw another question pop up. I'm gonna take a quick look at it if you don't mind. Okay. Ron has another question I'm going to throw in there right now. Actually, I'll do this one at the end, Ron, if you don't mind, because I'm going to keep going on this subject. It's a slightly different question. It's a good question, too. So again, the indices are very concentrated today. And here are, as of April 29th, the big index positions in the S&P 500. These are also big positions in the growth index I just showed you earlier, not surprising. And again, some of these numbers have actually come down a bit here. I know so this morning, Amazon, is down to about 1.15 trillion in market cap, but it's still pretty big. And what you see here, so the names of the 5 names of the big winners. So these are, again, the 5 largest names, the capitalization weighted, right? These are the biggest companies in the United States. They're also the biggest companies in the world. Market capitalization, that number I mentioned earlier, number of shares outstanding times the current price. And you can see Apple at least was a $2.6 trillion company, which is still, wow, think about that. And even Tesla, which is probably a more controversial company in a lot of ways, and perhaps depending on your point of view on these such subjects, is still almost a $1 trillion company. PE on the right side of the screen. So this is the price divided by the last 12 months earnings. So Apple, you can see 26 times, all the way down to Amazon at 60 times, and Tesla at 118. So one way to think about PEs, because PEs aren't something that most of us really can wrap our heads around, but one way to think about it, if you actually invert it, and I'll give you an example in a minute, I promise, it kind of gives you what we call an earnings yield, which is an interesting number. So for example, take Apple. If we round down to 25 times and we invert it, we get a 4% earnings yield. So that means that essentially Apple generates earnings that are equivalent to you as a shareholder getting paid 4%. Now, the reason that you would accept a 4% yield is because you think the risk is either very low or you think the growth is going to be really high and they're just going to keep cranking out more and more profits, which they will probably do. There's another rule of thumb, though, to think about here, which is that a company's, this is from way back when, I'm going to sound like a very, very mature investor at this point, maybe not emotionally, but at least age-wise. The old rule used to be you don't pay more than the growth rate for a stock. So that gets to the interesting question, can Apple grow at 20 or 25% per year for an extended period of time? Well, first of all, it hasn't done that in a very long time. It's growing 6% per year or so, give or take, depending on what numbers you look at, not 25% a year. And also, how much bigger can Apple actually get? I know I have my 3 devices I'm looking at right now on my desk. I'm not going to buy 3 more, I can assure you. But the point is that it's expensive. And if you go down the line, even great businesses like Amazon are trading at less than a 2% yield. And then Tesla is trading at less than a 1% yield. I'm inverting those PE ratios. These are very expensive stocks today. And again, it doesn't mean they're going to be bad investments, but it does mean their odds aren't that good. They have to grow very quickly. And by the way, as we've seen with some of these other areas in the market, they also have to have people continue to maintain faith in them, which doesn't happen, by the way. People give up amazingly quickly on even big companies. So now we're going to switch gears a little bit and talk about what the problem is that's emerging for a lot of these names right now in particular. So this graph looks at the percentage of S&P 500 stocks by name, I believe this is, not by weight, that have dividend yields that are greater than the 10-year treasury. So we're going to talk about interest rates in a minute. But what you can see here is that for a long time, these guys at Strategas, we buy research, they seem to love this 1990 start point. So you keep seeing it, I'm sorry. But 1990 through 2008, basically, interest rates were higher. And when that happened, essentially what you got is that, basically you didn't buy stocks to get a higher yield than you get on a treasury bond. You would own a treasury bond if you wanted to yield. And then what happened is, you can see this pattern changes dramatically in 2008, 2009. And the reason that happens is because we have this thing that we're now going to deal with for a little while here, probably called quantitative easing, which is the Federal Reserve and other central banks around the world during the great financial crisis. By the way, I would argue correctly so, stepped in and said, we are going to have a global depression if we don't do something about it. So they went in and they created this program, which was experimental at the time, and still is, called quantitative easing. And what it means in English is they're buying bonds with their balance sheet, essentially, which they can create money out of nothing. That's how the central bank structures work. And they're using that, they do that to keep interest rates artificially low. And that's what we have. And we'll see that in a second, how that looks. And what that did, and it did exactly what it was supposed to do in one way, which is it tried to push everyone who was a saver, who was sitting in comfortable treasury bonds, into becoming a stock investor, because the Fed was giving you no choice. If you're particularly a retired person living on income, if interest rates are that low, you suddenly have a huge cut in your retirement income if you were living off that income. So it tried to push people out the risk curve, which is what it did. And you can see how it cycled, but generally speaking, the S&P 500 became incredibly attractive. Individual stocks had dividend yields that were much greater than treasuries. And that's largely because treasury rates were so artificially low. And then you see the right side of this graph. Now, again, this could repeat where this 21, which you see that we've had bottoms before at this level, but our bet is no, it's not going to repeat. This came down because interest rates have started to rise. And that has given more that's created competition for stocks. Dividend yields, by the way, have been rising too a little bit, not because dividends are getting bigger per se, but because stock prices are falling. When stock prices are falling, the yield goes up, assuming the dividends get cut. So this 21 is now coming down. And part of the thing that's risky for equity investors today, if you're still on this train, is that it probably doesn't come up. And the reason it probably doesn't come back up the way it has before is because the Federal Reserve now has an inflation problem. They didn't have an inflation problem during this entire period. So they kept what we call the QE train rolling. They kept doing more and more and more of it. It could arguably will be remembered as a huge mistake from the last 10 years of it, at least, but we'll see. And the fact is that with inflation higher, the Fed is not going to continue to do as much quantitative easing. In fact, they've announced quantitative tightening programs, which I don't know if they have the guts to stick with if the markets keep going down. But the fact is quantitative tightening is the opposite of quantitative easing. Essentially, they take bonds out of circulation, they rebuy them essentially. And that is the point is to let interest rates go back to a normal level because they have not been there in a long time, as you all know. And that gets us to this chart. So this is a look at inflation and the 10-year treasury yield from 2010 until I think today. I think it's April 29th again. Even though you can't see the label at the bottom looking at it that way. So the gray line is inflation, rolling 12-month inflation. And you can see that, it's had its moments where it was 3 or 4%, but that was a long time ago. And most of the last, 8 to 10 years, inflation has stayed below 2%, actually touching 0 in 2015, sub 1% in the beginnings of the COVID crisis, very, very low inflation, which is why the Fed and other central banks didn't really have to do anything different than they've been doing. Even though it wasn't working that well, the fact is it wasn't doing any obvious harm. The blue line is the 10-year treasury yield. Now, here's an important point for those who don't think about investing all day. The fact is that if you're going to borrow money, if you're going to lend somebody money, in this case, the US government, you have a reasonable right to say, I would like to have an income or a yield from that bond I'm buying, which is you lending money to the government again. I would like to have a yield that's higher than the inflation rate. I mean, that's a very reasonable thing for a bond investor to expect. And for the most part, that's sort of what happened. You can see how bond yields essentially sort of track treasuries for a long period of time here. In a normal world without quantitative easing, they would be 2 or 3 percentage points above. So I don't know if you can see my mouse, but the 4 to 5% range is probably where bonds should have been over the last 10 years, but they weren't because of all the bond purchases I mentioned earlier. So that's all fine. That's academic. It doesn't have to happen. We can see it hasn't happened. But now look at the right side of the page again in the thanks for telling me something I already know category. Inflation has taken off. It's not going to stay at 8% per year, 8.5%. I think our graph got cut off at the top. It's a little bit more than 8 today. It's going to come down. But is it going to come down to 2 or 3% again, or 1 or 2%? Our bet is no. It looks like, we're not economists, so I'm going to hide behind that. But the fact is that it's going to come down, but it's not going back down to where it was. And more importantly, if the Federal Reserve is going to have to abandon some of these aggressive bond purchase programs they've been using for 10 plus years now, interest rates should what we call normalize, which means that even if inflation comes down to 2 to 3%, a 10-year treasury should be 4% or so in yield. That's where it should be. And it's not there today. As we know, it's closer to just sub 3% as we speak. So the problem for an investor is that the process of this coming back to where it should be means you lose money on bonds. As interest rates rise, bond prices fall. That's how you get to the same kind of level. So this is a very big problem, and it creates a lot of anxiety for the markets and for people. And then last but not least on this subject, and there's other things we could talk about, but I want to torture you too much. This is the S&P 500 problem. So this is the problem. I showed you a graph or charts last week. I don't know if everyone has the old presentations, and I'll try to resuscitate these from time to time. But this is something called the Shiller ratio. And most people don't know what a Shiller ratio is, but for those of these calls regularly, you've probably heard too much about them. But Shiller ratio, so Bob Shiller is a professor at Yale, and he came up with this very interesting idea. So let me go back for a second. I want to show you something. So these price earnings ratios, I mentioned the E was the last 12 months earnings. And what Bob was worried about was, okay, that's fine, but in a booming period for the economy, the earnings are going to be artificially high. In a depression or a really tough recession, they're going to be artificially low. And when that happens, these ratios get distorted, essentially. They look actually lower than they are in a good market because E is going to come back down. They look higher than they really are in a bad economy because the E's are going to go back up. It's sort of the idea of just cyclicality in earnings. So what he tried to do to fix that problem was, I'm just going to come up with a really simple heuristic. I'm going to take 10 years of earnings for the S&P 500. I'm going to adjust them by the rate of inflation so that I'm not dealing with inflation affecting my numbers in any way, shape, or form. And that's going to be my E. So as opposed to the last 12 months that I showed you a second ago, this is 10 years of inflation adjusted earnings. And the beautiful thing about this, so the PE is price over that 10-year inflation adjusted earnings. That's what it is. And the reason it works is because it does get you through these cycles. It gets you out of that problem of the economy. Usually you have a good and a bad economy at least once or twice in a 10-year period. So here's the problem for investors. And I don't have the chart here this time, but there's a direct relationship, a very good one, by the way, or bad in this case, between price earnings and future 10-year returns. And what we showed last time is that when the valuation, and I'll get to this in a second, of the S&P is as high as it is today, the forward returns for the index, including dividends, are 3 to 4% at best. If the PE ratio was lower, the returns are 10, 12, 13% at best. So you want the PE to be low. The problem is that it's funny to think about it. What other part of our lives do we like prices to be high? We all like high stock prices because we probably own stocks. So at least we have in our funds at the Vermont Community Foundation, and we're happy about high prices. But the reality is, just like you go to the supermarket and you get less for your dollar, well, you're getting less earnings for your dollar in the S&P 500 today, even though people aren't as troubled by that as they are with supermarket prices. So the challenge is this. Here's the historic norm, that black line, about 17 times is the normal PE for the Shiller ratio, I should say. And you can see this is through April 29th. So we got most of the fall in the markets that have happened in 2022 in these numbers. And it's still 32 times, which is basically double-ish the long-term fundamental value of the index. And you can see it doesn't have to go all the way back to the bottom. We're not predicting a market crash here. Please don't take this as a sign of what's about to happen. But what it does tell us, I'm going to come back to something in a minute, it tells us that there's a lot of headwinds facing the markets because these valuations can't stay this high forever. We would suggest to you that inflation returning, that Federal Reserve's policies changing are the instigators or the inspiration for this coming back down to a more normal level. And the problem is it's a long way down to the average, even if it doesn't come all the way down to the average. Again, 17%, 20% loss doesn't look like that big a change on this graph. And that's the problem, because another 30% loss still will leave it a little overvalued. And that's what should be so troubling. But I really want to give you this. This is really important. Shiller ratios, I'm telling you how important they are. I'm going to give you a statistic right now. The correlation between the Shiller ratio and the next 12 months return for the S&P 500, which is actually what most people care about, is literally zero. Zero. So when you look at this chart and you say, well, what does it tell me about the next 12 months? It tells you nothing. So the S&P 500 could be up 30%. It could be down 30%. We don't know. But what it does tell us, which is why we're so focused on this, it tells us there's actually has a 0.7, which is a very high, for those who don't do statistics all day, correlation to the next 10 years of returns for the S&P. So we're not worried about whether the market will be up or down in the next 12 months, but we are very worried that this Shiller ratio tells us that the market will not give us a good return. And if you go back to the very beginning of my presentation, CPI plus 5. If inflation is going to be higher, and we're going to add 5% on top of that, getting 3 or 4 or even 5% if we're lucky from the S&P 500 isn't going to cut it. And that is what worries me immensely. So a couple more quick things and then I'll wrap this up. There are more speculative corners of the market that I was referring to earlier that have really struggled. And so one of the ways you can measure speculative activity, there's a lot of ways to do it. This is a very interesting way to think about it, which is to look at the portfolio, look at the Russell 3000. Because those are the 3,000 largest companies. These are what we call price to sales ratios. So everything I've been talking about before is actual earnings, i.e. what are the profits of a company? This is just the sales. So assuming, I think we can all safely agree that every company with sales has some kind of cost to produce the good or service that led to those sales. So these are not profits. This is the profits are way lower than this, but they're there. And you can see here, this is the left-hand side again, 1990, once again. This 14.3, that was the peak of the dot-com boom / bust. It got as high as 18% in mid-2021 when the market kind of the speculative blow off that led to some huge declines since then, as you've seen in certain funds, I'll leave nameless, which we don't own. And you can see here, the right side is this coming down to earth more recently. But even with that, we're still above the level. So there's a lot of risky companies out there trading at very high valuations. And so even with the massive declines we've seen, there's still a lot of risk out there of speculation and overvaluation. These are generally not the bigger names in the index, just to be clear, these tend to be smaller names. Although I will say Tesla sneaks its way into this list from time to time. I'm sure they're there now, but nevertheless, there's a lot of people paying a lot of money for stocks. Again, greater than 10 times sales. Forget about earnings. Very interesting. Okay, so why are we excited? I feel like I've given you the most unbelievably pessimistic thing I could ever deliver. You're not going to make any money in bonds. You're not going to make money on stocks. Inflation's rising. It's terrible. But the complexity of this world and the way markets are structured today has created some incredible opportunities. So in the portfolio, we have value-ish names trading at mid-single digit valuations. Remember I said the earnings yield is 25 times for Apple, or 25 times is the price earnings. It's a 4% earning yield. One of the positions in this portfolio is Micron Technology, which is a decent technology company too. It's trading at, on this lowered because it's a little higher than this, but it's trading at essentially 5 times next year's earnings. And that's a, last time I checked, a 20% earnings yield. So this portfolio has names like that and others. There's quite a few of them, by the way, in the value-ish side of the equation or the cyclical side of the equation. We also own disruptive businesses, things that people sometimes have concerns with, but are probably good businesses, things like Carvana. Carvana is trading at 0.4 times sales. So we'll go back for a second. 0.4 times sales, nowhere near 10 times sales, just to be clear. That gives you a sense of it. And Carvana's market capitalization in the last 12 months has gone from 50 billion to 5 billion. It's not a bad business, it really isn't. But the market, so that's the kind of blow off we've seen in speculative names like Carvana. Another big position in this portfolio is ASOS. ASOS is an online UK fashion business. Some of you may see their packages from time to time come to your door. I know I see once in a while, not for me. And that's trading at 0.3 times sales today. So my point is there's some amazing bargains out there. We have investors who are really good at understanding these businesses and making sure they buy the ones that are going to survive and be fine. And most of these companies don't have a lot of debt or any other issues to really worry about. They're just not making money today. And that is something that the markets are punishing indiscriminately. So last thing, 3 key points that are the reason we're going to go back to that beginning, and we're going to have a hard time with the indexes getting us the CPI plus 5, but we're going to either close that gap or completely eliminate it because people want to give us Micron at 6 times and ASOS at 0.3 times. We can make money essentially for the foundation. So strict adherence to strategy that relies on long-term success. That's where we don't guess what inflation is going to be next year or where the market's going to be. We have no idea. What we do have an idea about is that Carvana, to use a simple example, will probably be worth more 5 or 10 years from now than it is today. We have even more confidence in something like a semiconductor business like Micron. Second point, utilize the advantages of scale and stability. The foundation pools are both over $100 million today, and that gives us a lot of opportunity to invest in some pretty interesting people who are way off the radar for most and do this job really, really well. And then the time horizon is immensely important. We love index funds. We're worried about them for the reasons I mentioned a minute ago, but they're still worth having in portfolios. And then last but not least, this last point is really important, which is over long time periods, accept the fact that volatility contributes to higher returns. So we don't mind volatility. We like it. I don't like negative returns. I know I don't like showing them to you, and I certainly don't like underperforming like we're doing right now. But the fact is that these are the things that we've done for 20 years, and it's worked out quite well over time. And this time will be no different. I'm not allowed to make promises, I know, but we are incredibly confident right now in the long term, not the short term, just to be clear. And last but not least, crucial, not a commercial, I'll give you a quick version. We don't manage money. We pick people to manage money. We advise Dan and the committee about how to build the portfolio. We are independently owned, based in New York City. You can see a little bit about us here. I'll just remind you, we have no conflicts of interest. When we do something wrong, it's just pure dumb. It's not because we don't have an incentive to do anything wrong ever from a fee or other perspective. So I'm going to pause there. I did have a question in the chat I want to answer, and I'll see if anyone else has a question. I see there's 2 has come up. So one is on private equity. To what extent are the VCF pools invested in private equity firms that are purchasing private residences and taking these off the owner-occupied market, placing them into the rental market? None. We don't do that. That's not a strategy we're using in the portfolio. So that's a strategy you do see in private equity. We don't like the strategy, just as a general rule. And I will tell you, there's always been there's a lot of different lenses. Sometimes that type of strategy, we do look at everything. Those strategies can be good and they can be socially good, but they can also not be. And so if there's a risk that something would be socially negative for a community, the Darmok Foundation is generally not interested in doing things like that, as you would hope. So no. How are we factoring climate change into all this? Yeah, in a lot of ways. One is there's a few things happening, most of which I can't show you yet, but I'll just briefly mention. One is, first of all, the SR pool is a huge focus on climate change. And we use people like Generation as a manager in there who's been one of the leading proponents of investing with climate change in mind and with the risks in mind. That's one thing we're doing. Second thing is the Vermont Community Foundation has not for years made investments in private investments in oil and gas out of concern for this. Both both in terms of our climate and also in terms of whether or not you're going to be actually paid to invest in that kind of stuff. That's the whole point of a lot of what climate change is concerning, because it's our planet, obviously. But if you're an investor, it's not a layup that that oil and gas is going to be a good place to be for a long period of time, even though it looks fine right now, I suppose. So the answer is we're factoring that in by avoiding certain things. We're also, this is something that we'll be talking about with the committee later this year. We're building a data engine at Crucial that essentially measures carbon footprint for every portfolio company, every manager, and the roll up to the top. So the committee, Dan, and everyone else at the foundation is going to be looking at data that is very company specific, and we're looking to integrate that into the thinking around portfolio construction, risk, et cetera. This is very much kind of in process, but we're making a lot of progress at Crucial, so I'm pretty excited about it. And so I look forward to at some point in time being able to share that with you. And then one more question, and I'll stop to see if others have questions they want to ask online. So Mike, it appears the change from Colonial to Crucial is a name change, same firm. Can you comment? Yes, same firm, just a name change. The answer was that, first of all, none of us, even I who joined Crucial/Colonial in 1986, was there when the firm was named. So we didn't own the name ourselves. Two, the name Colonial is a complicated name, and we decided we wanted a name that was less complicated for us, at least, and maybe for some others. And Crucial, just to tell you where that kind of crazy name comes from, you appreciate this, many of you. Crucial is a reference to teamwork. So my daughters were actually competitive rowers. I didn't pick the name Crucial, but I like it for this reason. So crew is a reference to competitive rowing. And one of the things we love about rowing, if you haven't watched the sport, is it's the ultimate team sport in the sense that every person in that boat needs to do their job and do it well if the boat's going to do well. So there's individual responsibility and teamwork at the same time. And so we kind of view that as the way you build a great portfolio, is you have individuals that are responsible for what they do, and they come together as a team to generate a great outcome. So that's where Crucial, the name, came from. So again, a little bit of, we wanted our own name, and we were definitely de-emphasizing other names. There's another question that came in, but does anybody want to ask questions live before I get the last question that was sent in the chat? I'm gonna do the chat question because it's actually one I want to answer too. I don't want to answer them all, of course, but this one I love too. It's one thing to assess companies for their exposure to climate change. It's another to invest in companies that are actively working towards solutions. What would you comment on how you relate to this difference? Yeah. An excellent point that I completely left out. So William, thank you for making sure I got a chance to not leave it out. Two things are happening in this regard. So one is we do have public equity managers, particularly in the SR pool today, but not exclusively in the SR pool. Generation is one I mentioned earlier. Another firm in California in Redwood Grove are very focused on solutions. What businesses, by the way, in some cases, businesses that currently today you'd probably put in the problem box, but they think are changing the way they do business and therefore become more productive companies. That's one thing. All the questions really about people actually producing solutions. So you see a little bit in the public markets of the managers we pick. And so that's one. And then two, the foundation's made allocations, we'll make more allocations, by the way, to private funds that are also solutions based. I'll give you one example. We have a firm in California named At One Ventures. This is a firm led by, I think, an extraordinary human being who is completely focused on finding solutions to climate change and investing in younger businesses that are doing that. It's so far an incredibly profitable strategy. He's built some really interesting businesses, and hopefully one of those businesses is going to make a major contribution to saving our planet. And so the Vermont Foundation is very actively looking to address these issues proactively with its capital and not just reactively. Well, I think the 10 o'clock hour is almost arrived. I don't know if Dan's going to kick me off and make me stop talking, but if there are other questions, I'll try to answer them quickly if that's okay.
Yeah, let's take leave space for one more question, and then we'll shift over. We've got a meeting of the investment committee starting at 10 as well. But I don't want to cut off this discussion. As a complement to Mike's observation, we also have within the Vermont pool a number of investments that have been focused on climate solutions, including a position in Sun Common that was recently sold to iSun, did well for the pool, and Encore Renewable is another holding in that pool that's focused on climate solutions, and a big partnership with the Vermont Land Trust around conservation. So there are place-based solutions or strategies that are tied to climate work that are part of the portfolio as well. Thanks, Tom. Other questions? Final question for Mike. Nice to see everybody. Thanks for joining us this morning. Feel free to reach out either through your philanthropic advisor, through me. Again, I'd like to just acknowledge and welcome Nancy Brock in her first public investment call. We're thrilled to have her aboard. But I'm going to steal Mike away for a meeting with the committee, and if that's okay with everybody. Thanks for your patience, engagement. Well, since I just see him on the squares, I should also acknowledge that Paul Cielo recently announced his pending transition from Public Assets Institute, which has been a long time and key partner of the Vermont Community Foundation. So Paul, it's good to see you on the call, and congratulations on your journey into the sunset. I hope you won't go too far.
Thanks, Dan.
Cheers, everybody. Thank you.
Hi, everyone. Thank you.